I've always been a bit skeptical when it comes to covered call ETFs. The risk of capital erosion usually keeps me away. But 3 months ago, I decided to take a chance and open a small position in the iShares WINC ETF. I've already covered the technical details of this ETF in a previous video. So, why did I buy it? I wanted to see how it moves, and more importantly, what kind of cash flow it actually generates. After holding it for nearly 3 months, my first payout has finally arrived. And I have to tell you, I'm impressed. It's not just about the payout. The overall performance has been great too. In this video, I'll give you a quick update and share my next steps for the WINC ETF. But as always, this is not financial advice, just my own opinions and experiences. If you're new to WINC, here is the quick version. The iShares World Equity High Income Active ETF, better known as WINC, is a relatively new, actively managed fund. It invests in developed markets, very similar to the MSCI World, but offers massive payout yields. These payouts are made up of traditional dividends and premiums from selling covered calls. But unlike classic covered call ETFs, WINC uses an extra financial tool: futures. By using futures, the ETF tries to capture market upturns more effectively to deliver better price growth. Back in early February, I invested €5,000. Since WINC pays out quarterly, in January, April, July, and October, my first payment hit my account this April. The amount? €136. I've got to say, I'm really impressed with those numbers. That is a 2.7% return on my initial €5,000 investment. If we project that over a full year with 4 payments, we're looking at a yield of roughly 10%. Those are some serious numbers. Last year, WINC paid out 9%. Seeing it potentially hit double digits this year is impressive, but we have to ask, is it sustainable? Personally, even if the yield settles around 6% or 7%, I'd be happy, provided the share price stays stable. This brings us to the biggest fear with income ETFs: capital erosion. Many European investors look at JEPG for high yields. It's a massive fund, managing over €1.2 billion, and easily the largest global covered call ETF on the European market today. But if you look at the price performance, JEPG has been a bit of a disappointment lately. You get nice cash flow, but your main investment slowly loses value. With WINC, however, the price chart looks like this. Since I bought in here, my position is well into the green, which is exactly what I like to see. Let's look at a total return comparison between WINC and JEPG. While JEPG is still struggling to recover from global trade tensions and policy shifts, WINC has already pulled ahead. It seems that futures strategy I mentioned earlier is really paying off. If you're enjoying the video, a like and subscribe really helps the channel. Thanks. I want to show you one more interesting thing. Here we see the fund growth of both ETFs since the start of the year. This essentially shows us which of these two funds is winning the trust of investors this year. We can see that WINC has almost doubled its fund volume since January, while JEPG only grew by 7%. I get the impression that JEPG's weak price performance is making a lot of investors nervous right now. But let's go back to the main chart for a second. Let me add the MSCI World as a benchmark for comparison. Since its launch, WINC has actually managed to keep up with the MSCI World. And honestly, that is mind-blowing. WINC isn't just giving you huge payouts, it's keeping pace with the broader market. And really, what more could you ask for? Yes, we are looking at a very short history of only 2 years, but still, What this ETF has delivered so far is very convincing. So, what is my plan for the WINC ETF moving forward? In earlier videos, I mentioned that my position is still small and that I want to grow it to 10% of my total portfolio. I'm sticking to that plan and will continue to buy more shares. If WINC continues to prove itself with good performance and solid payouts, I could even see myself increasing that to 15% or 20%. But that's a conversation for the future. And now, I want to hear from you. Are you holding covered call ETFs in your portfolio? Or are you sticking with more traditional dividend ETFs? Let me know in the comments below. If you found this update helpful, please give the video a like and subscribe to the channel for more income investing insights. Thanks for watching, and I'll see you in the next one.